Hello, everybody.
Yes, hello.
Hello, welcome to another review and class for basic Forex. We might have some people coming in this class accidentally because the other class is been cancelled for today. So as they come in, I'll have to keep repeating what we are doing so that they're aware that they might be in the wrong class. But anyway, having said that, welcome once again. I hope you are able to download your CTrader. That's number one item, CTrader. If you haven't, then towards the end of this session, I'll have to go in there and see what you can do. So CTrader. So the four of you that are here, actually five, were you able to do that? So I'll start with Kathy. Were you able to download CTrader or log in? Well, Kathy doesn't seem to have any voice or anything. Can you text? Tell me if you were able to download that. What about Isaac?
Yes, I managed.
You managed? Good, good.
I managed, and I put some two trades, but they all went opposite.
That's okay. That was the most
Yeah.
important thing was just to download and have it ready. Putting the
Okay.
trades, that's my job to help you now. Okay.
Okay.
Albert?
Okay, I haven't managed to download.
Hmm.
I have a Linux machine, and I had trouble finding a version that was compatible with Linux. But I've found a solution on how to solve that. So probably by the end of the class, I will have downloaded it.
Okay. But then you can also do the web version.
Okay.
Yeah,
Okay, yeah.
yeah. So there are many ways to go about it. Um, yeah, just do the web version. Okay. Catherine, can you indicate whether you have been able to download or not? Please send a message so I know that you're able to download it or not. What about Charlotte? Were you able to download CTrader? Okay, I guess those two are neither here nor there. All right, anyway, I'll assume you're here. So the first thing that I was going to check was whether you have done your downloading or something. The next thing is we shall jump into the market, not in the charts yet, but I'll give you a little background of the market structure. Now, last class we were talking about how people make money, and we said you make money when the market goes up or when the market goes down. When the market goes up, you're making money when you buy. Okay, so when the market is going up, you're making money when you buy, and we agreed that when the market is going down, you make money when you sell. All right. So, what is the structure of the market? In other words, before you even talk about buying or selling, how does the market move? Well, that's what I'm going to talk about in a little bit. So, there are three faces of the market. There are technically two, but there's one that isn't talked much about. So, the market has three faces. The first phase, which we all know, is the ascending and descending. Well, actually, not ascending, descending, but the trends. So the first one is the trending phase. Okay. So trending phase means the market is going up and up and up and up like that. That is a trending phase. Okay, so that if this is point X, so then this can be a high. Okay, and this is a low because the low point. But then this one here, it is a higher high. Okay, and this one is a higher low. And basically, that's how it goes. This is another higher high. But even though this is a low, it is a higher low. So if this is a high, this is a low. If this is a high, this is a low. If this is a high, this is a low. So sometimes you hear people saying, well, the market was on highs, higher highs, and higher lows. So this is low, higher low, higher low, higher low, and so on. So this is an uptrend. Okay. So there's no rocket science here. It's very basic stuff. So this is the part that becomes confusing. Well, not confusing, but another way of looking at a trend is when the market is going down. So it comes like this. Let me use a different color here. Okay. When the market is going like that. Okay. Something like that. And here, the opposite is what happens. So if this is a point X, okay, we say this is a low. Okay, and this is a lower high. Sorry, a higher low. Well, it depends on how you call it. Because I'm going to say this is low, this is a lower low, this is a lower low. Okay, and this is, if this is a high, so this becomes a lower high. This becomes a lower high. So don't let those names confuse you. It doesn't matter. Just remember, if the market is going down, everything starts with the word low. So with the exception of this low and high, yeah, the rest is lower low, lower high, lower low, lower high, lower low, lower high. Okay. So meaning the market is coming down, but it keeps going up a little bit. Then it goes down, and then it goes up a little bit, and then it goes down. Okay. So this is called the low. But then this is a higher. Sorry, right now it's high. But as we come down lower, so this is a lower low because it's lower. You draw a line like that, then this is lower than that. This point here is lower than that. Okay. And then if it goes even lower, then this point here is lower than this. So that's why it's called a lower low. Okay. But this point here, if this is a high, then it is lower, as you can see. You have to come lower. So this is a lower high. Okay. So this is down below, lower low, and then lower high, and so on. So it's just the opposite of what you see here. So the market moves, they say about 30% of the time, not much, 30% of the time on a trend, whether it's going up or down. Now, the other 30%, somebody just calling. Hello. Yes, are you in the class? Well, so you didn't read your messages. You don't read your messages. Yeah, okay, but 10 minutes, okay. Okay, I've just logged you in, yes. All right, okay, so, okay. Sorry, guys. Okay, so we're talking about higher highs and higher lows, right? That's the first phase. The other phase is what we call consolidation. Okay, I'll call it 2. So this is 1. Okay, 1. and this is 2. So we call it a consolidation phase. Consolidation. All right. These are very important things to know before you actually start trading. So consolidation means that the market is stuck between, so sometimes we call it ranging. Another word for consolidation in Forex is ranging, and the market is ranging. Now, ranging from the word English means it is just jumping from one point to another point. If you draw 2 lines like that, you'll find that the market was actually doing nothing but just going between those 2 points. It goes up, comes down, goes up, comes down, goes up, comes down, goes up. So the fact that it's going between 2 points, basically point X and Y, okay, this is called ranging or consolidation. So the market spends about another 30%, 30 or 40% actually. Well, sometimes even more, almost 60% of the time in ranging. Okay, and then they say, well, this is not quite exactly correct. I think, let me erase this. Not 60%, no, about maybe 40%. 40 or 50%. In other words, it spends a good chunk of its time just playing around, and then a small part on trending. And then the other, maybe 5 or 10%, it does a bit of both. Okay, so that other part is not normally talked much about, but if we were to express this again, okay, so the market either trends, okay, or ranges. Trending means, if you look at the big chart, you'll find that maybe the market is going like this. Okay, then so the point here is, as you can see, here it's on an uptrend. Then here, the market is ranging. Then here, it's on an uptrend. Then here, the market is ranging. Then here, it's on a downtrend. And then here, the market is ranging. So what I'm going to teach you guys is called scalping. Scalping means how can you get into the market and get out very quickly. Make some money and get out very quickly. Okay, what am I doing? Okay. So scalping is getting in the market quickly and getting out. So in scalping, what we do, we take advantage of this movement, okay? If it's going up, you take advantage of the move from down there to up there, okay? From down there to up there, or from up there to down there, before you get caught up in this range. Now, normally, unless you know how to trade the range, you kind of avoid it, okay? Unless the distance from here to here makes sense. What do I mean by making sense? If the distance from here to here, let's say, is about 12 pips, okay? About 12 pips. Well, then if you're trading, you can just shoot for getting about 2 pips. 2 pips, very small. Otherwise, if you do the whole thing, then you're in trouble. Let me answer this again. Hold on. Okay, sorry guys. So scalping, that means if the distance from here to here is 12 pips, all you want to get is a small bite of the 12 pips. Okay, and I always say, if you can get 2 or 3 pips from that market, take it and run. Take it and run, because it's easier. It's easier to get 3 than to get 12. So if the market is moving from down here to up there, so the market goes like this. So at this point, it might go up or it might go down. You don't know. So for you, if maybe you are sure that now the market is going up, if the market can give you just a small fraction, this small fraction here, okay, and that could be like 2 or 3 pips, take it. Take it and then wait for the next opportunity. Why? Because statistically, it is easier to get here. The market is more likely to reach here before it goes and reaches up there. Now, getting up there is not guaranteed. That extra move up there is not guaranteed. But once you see the market going up, you have a higher chance of getting this than getting the whole of that. So, and that is why scalping, they always say scalping means you go in, you take small bites from the market, small bites. So, but anyway, back to our market structure. So those 3 phases of the market, which is basically uptrends and then consolidation and then downtrends, okay? You as a scalper, you take advantage of the trends. If you must trade in the consolidation, then make sure you start at the bottom. You don't wait and take trades over there. You start at the bottom, where bottom is once you're sure the market is going up, then you enter somewhere there and you come out like before you get even halfway through, okay? Why? Because you're more likely to get this than to get the whole thing. So if the market is consolidating, you have to be careful. You get your 2-3 pips and then you're out, okay? If the market is actually trending, that's a different story. So for a trend, what you do as a scalper, the strategy is, you see a trend means the market is going up and then going down a little bit, and then up, and then going down a little bit, and then up, and then down a little bit. So here in scalping, what I teach people is, once you know that the market is going up, all right, you don't take your trades at point A. Well, you wait first and confirm. This is point B, C, D, E. So what you do is you take trades Okay, it's a bit orthodox, but that's what I normally teach. When the market is actually coming down, see at this point, B, where the market seems to be coming down a little bit, we call it retracing. If the market is retracing or coming down a little bit, that's when you start doing your buys. You know, you enter a buy, but the market is going down, you enter a buy, you enter a buy. Why? Because this market is actually going to go up. So when now the rest of the market, the rest of the people are busy now buying, okay? When they're buying, for you, you're just reaping profit, okay? Because this market will come back, it will hit your profit, hit your profit, hit your profit. So that when people are selling, busy selling, you're buying. And then when you're down here, you actually start making profit when they are busy now buying. Now, that's a bit orthodox, not normal. Most people don't teach like that, but I'll show you how you can do that. But you only do that when you know you are in a trending market, okay? Or you know that the market is down, but actually it's going up. I don't know if you understand that, okay? So this is where you do your buying. You do your buying over there, okay? And then the market will go up, 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 up. When it reaches there and it starts going down again, then you enter your buys again, okay? And then the market will go up and you'll take profit, take profit, take profit. So when people are busy buying, for you, you're just taking profit, taking profit, taking profit. All right. So anyway, so that is on a trending market, okay, whether it's going up or down. On a ranging market, you only wait when you're sure. For example, if you're going to do a sell, so a ranging market goes up and then goes down, and then goes up and then goes down. So you don't start trading there until you've confirmed that it's ranging. So this 0.1, okay. Okay, let's say 0.1 or X, 0.1, 0.2, and 0.3. Usually 1, 2, 3, and 4. Once you see 4 points, in other words, you can draw a line at the top and a line at the bottom, then you can start your trading, which means that now, if this was here and it went up, then came down, and then it went up, then you know it's going to come down. Then at that point, you can do your scalping. You can sell a little bit and then wait for it to drop up to there. Then when it's down here, you can do the same thing. You can buy. So when the market is ranging, okay, be sure, confirm first before you enter your trades that actually it's ranging. But how do you know? Once you have about 4 points, 2 at the bottom and 2 at the top, then that confirms that the market is ranging. Hence, you can trade that strategy. So now we know about the market. The market has three faces, and the faces are trending, whether it's up or down, and then consolidation. Sometimes the consolidation phase, this phase sometimes is called, well, I told you it's ranging, but it's like a spring. Well, if you look at the chart very well, it will be something like this. It will never be a clean, perfect, you know. So not so much like this, but it might be something more like this, where it's not perfect, even it can go below, yeah? So sometimes people equate this to like, if you're small, there used to be a spring. You know what a spring looks like? A spring, okay, but it's coiled like that. So what they say is, when you release the spring, or if you take a rubber band and tie it around like that, okay, it becomes tight, 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 tight. And then when you release it, it springs out completely. So the market does the same thing. So right now we have it consolidating, and then it breaks either up there or even down here. So if it breaks, then it might go very high for a while, okay? Similarly, if it breaks at the bottom, let's say it breaks this, chances are it might go for a long while. So what scalpers do, they wait, they actually time the market. When they see this consolidation, they get excited and they put their, they put like a trap. They put like a sell limit or, sell stop. There's that's an order you put on the computer. You do a sell and you give the computer instructions, and this is a buy. So you're telling the computer that if the market breaks down, I want to enter that trade, okay? We're almost time up, but anyway, you want to enter the trade. But if the market is going to go up, you also want to enter the trade. So regardless of whether the market will go down or buy or down or up, you want to be entered in the trade, okay? When you're breaking from a consolidation. And that strategy is called a breakout strategy. Breakout. Now, if you hear people saying they are timing the London breakout, it means they're timing the market at 10 o'clock when the London market opens. The London market opens at 8, but it's London 8 o'clock. But here in Kenya, it's about 10. So the breakout means you are timing the markets so that at that 10 o'clock, when the market breaks out, you don't care if the market is going up or down. You don't. All you know is the market will break out. And when it breaks out, you want to be in the trades. You want to make some quick money. So as the market goes down like that, it goes with you. Or it goes up like that, it goes with you. Okay. So technically, during the London breakout, this is the market structure that we talked about. Okay, consolidation and then breakout and so on. But in general, there are three market cycles. Okay, 3 market cycles. So we call the first cycle, let's just put in the middle here. This is the London market. Okay, then we put, this is Asian market. And then we have the New York market. They follow each other, one after the other. So the London market normally is between 8 a.m. and let's say about 4 o'clock or 5 o'clock. Okay. Oops. 5 p.m. The New York session starts around 4. Okay. 4 p.m. till 11 p.m. Then the Asian market starts from 11 p.m. Okay, let's pretend this is 11 p.m. So this is the same time here and goes on till about 8 or 9 in the morning, or 9 o'clock in the morning. So what am I saying? What I'm saying is usually you find the Asian market is not very fast at night because at that time we are sleeping. Because normally I think Kenya is about a few hours ahead of London. Hence we experience mostly the London market and a bit of the New York market. Okay. So for us, let's see. By the time it's 8 o'clock in London, we will have been awake for a long time. So for us, I think it's up to about 11 p.m. Well, up to somewhere around there. So the busiest time of the market, of the Forex market, busiest time is between London and New York. So between 9 9 a.m. and about 5 p.m. Kenyan time. 9 and 5 p.m. So between this time, what happens is the London market opens up. Okay. When the London market opens up, the markets in Asia at night is very, very slow. So you'll find that at night, the Asian market goes something like this. Okay. So then at London, it quickly starts picking up pace. Okay, and then you find that now it goes like that. Okay, and then by the time we come to New York session, it slows down a little bit. And then by 11, it now goes back to the Asian session. So the busiest time is between this time and that time. Okay. Now, something interesting happens around London. You see, the Asian market at night, it's very quiet. It doesn't have much. It's almost like consolidating, nothing much happens. But then in the morning, just before 9, the market starts moving, moves a lot, moves. And then from around 10, it's like the market goes on fire. And there, if you are strategic, you can easily make some big money because now the market is moving. As you can see, it's moving, moves, so on. Then it slows down a little bit, and New York happens again, then it moves again. Okay, so a lot of scalpers make money during the London breakout, and that's where I will teach you guys the strategy you use for London breakout, London and beginning of New York. But the principle is this. The principle is you time and look at where the market is consolidating. Okay, where the market seems to be just going between certain points. Then what you do, you put your orders, put your buy. Basically, even in English, you can give instructions to the computer. You're saying, if you break this point and you go up, I want to enter a buy. And then you're saying, if you break down here, okay, I want to enter a sell, like that. Okay. There are ways of doing that, the system automatically, so you don't have to even sit there and wait, but you set it up. Once you set it up, when it breaks, whether it goes up or down, then it will break with you and you will be making some money without even having to sit and watch it. Okay. That is breakout, London breakout. Now, 2.5 minutes. Any questions? I know we haven't got the chat yet, but any questions so far? If it is too abstract, don't worry, I will explain this in the chat properly. But today I was just giving you the theory so you understand the market structure. Any questions? We have about 2 minutes.
Okay, I have a question.
Okay.
So you are describing. So when you describe the scalping, and you maybe the way I'm saying it is like you're contradicting. There's a contradiction because you're saying like in this there's a strategy you talked about initially, where you buy when it's retracing lower. But then I remember in you also said that when it's going lower, you sell. I don't know how to marry the two.
Yes, and that's why I said a strategy.
Okay.
A strategy. A strategy is one out of many. It is not the way it's usually done. The way it's usually done is when the market is there, you buy, you're going up, right? When the market is up there, you sell. That's the normal, traditional thing. However,
yes,
there is a strategy that kind of uses the opposite thought. And it is a dangerous strategy, because if the market is going down here, you know you're supposed to be selling. But
Yes.
if you start to buy, you'll be accumulating what we call losses, drawdown. So your account will start with very huge negative, because the market is going against you. Because the market is going down, but you're putting a buy. So this will become a loss, and a loss, and a loss, and a loss, until the market turns and starts going up. Okay. So that strategy doesn't work for everybody, and not all the time. Do you guys want me to add time, or are you okay with this? You better say quickly.
It's okay.
You're okay with this? All right.
Yeah.
Then we'll pick up the class